Yes, Shweta. So Indian markets witnessed another day of selling pressure, and there was a flattish opening this morning. Negative handover from the US equities, which, by the way, it's worst weekly decline since March of 2023, and a sluggish open in Asian equities, where we are seeing a 1 to 2% correction across the board in Asian stocks. Now, Nifty opened below the 19,750 mark, and Sensex was down about 20 points in the opening trade. However, currently the markets have fallen below. Nifty is currently trading below the 19,700 mark, which was being looked at a crucial support level for the index, whereas Sensex is also trading down about 50-60 points. Now, shifting focus to the broader market, Shweta, the broader markets were trading with moderate gains at open. However, the sentiment has turned bearish, and both mid cap and small cap indices are trading with losses of about 0.3% at this point in time. Okay. Now, among sectors, it's a sea of red. Most sectors are trading in red with moderate losses. Financials, which was seeing some sort of buying interest in the opening trade, has also turned negative, whereas PSU banks remain the outlier, and they are up about 1.5%. Auto stocks was also up in the morning trade. They were up about 0.4%. Currently, they are up about 0.11%. And IT pack and realty pack and metal pack, they are the ones which are trading with significant losses currently in this morning trade.
All right. So those, of course, are updates as far as stock markets this morning is concerned. So interesting, mid cap, small cap, that is, in fact, that have out rallied all headliners for a very long time now, saw some correction yesterday.
They did see some correction yesterday, and Shweta, if we look at the mid cap and the small cap pack, last week we saw there was one day particularly where mid cap and the small cap indices corrected by 3 to 4%. And after that level of correction, a lot of analysts were of the opinion, that the tide has perhaps turned, and, the sentiment could be bearish for the broader markets moving forward. But, as we saw, the tides turned once again, and mid cap and small cap indices have been outperforming the markets, which, by the way, are scaled all-time high levels. Last week, currently we are seeing some sort of a pressure where the markets have fallen about 2% from its peak, and Nifty is trading about 19,700 levels.
All right, and let's also quickly take a look at some of the stocks we are tracking this morning before we go to our guest to understand how markets are likely to perform perhaps next week.
Yes, Shweta. So, among the stocks in focus, let's start with Glenmark Pharma and Glenmark Life Sciences. Now, Glenmark Pharma will sell about 75% stake in Glenmark Life Sciences for a consideration of about 5,651 crore. Now, at this level, each share will be sold at about 615 rupees in Glenmark Life Sciences, which is at a slight discount from yesterday's closing. Now, Glenmark Pharma, which currently owns about 82.84% stake in GSL, will continue holding about a 7.84% stake post the deal. Now, after the deal, Nirma Group, which is the buying buying company, Nirma Group will become a new promoter of the group, and Glenmark Pharma will be reclassified as public shareholders. Now, if you look at the stock, Shweta, Glenmark, we have seen a rally in pharma stocks across the board. Now, Glenmark Pharma is up about 95% year to date, whereas Glenmark Life Sciences has rallied about 50%. However, both the stocks are trading with moderate losses, as you can see on the screen. Glenmark Pharma was down about 4.59% in the morning trade today, whereas Glenmark Life Sciences fell about 1.48% this morning. Now, another stock that was in focus today, Shweta, was Vedanta. Now, Vedanta Group, the board of Vedanta Group has approved raising funds of about 2,500 crores via non-convertible debentures in one or more tranches. They'll conduct the fundraising, and the company says that the issuance of NCDs is a part of the routine refinances that is undertaken by the company in ordinary course of business. Now, very interestingly, as we know, Vedanta has been under the scanner because of the high debt on its books, and we are seeing yet another refinancing or financing taken through that route.
All right, and so those are some of the stocks in focus. We'll come to the rest of them, but Kush Bohra is joining us on the show. Kush, thanks very much for taking time out. I think you're on mute, but I want to begin by asking you, what are you making of markets? Are they in a consolidation phase? There's a marginal uptick this morning. A lot of experts that we've been speaking to for the past 1 week said that this is the much needed consolidation phase and it begins now. It's not happening.
Hi, first up, thank you for having me on the show. Well, this kind of a market where participants want the market to come down, they want the market to go into a consolidation mode, and thankfully the market's actually kind of obliging. I know this that the dip actually has been quite sharp, to some participants' comfort, but I think this was a much needed one. The way we are looking at it is that this is perhaps a springboard. If the Nifty has to go to 20,300, 20,500 kind of levels, say by Diwali, then we needed this kind of a dip, a pause for the market, especially in the mid cap and the small cap names, where it was a lot of overheating, a lot of overstretching. Then just makes it a little difficult for new participants to enter. There's a lot of money and there are a lot of participants waiting on the sidelines to enter. So once the dust settles, I think we are in for a rebound. But as the case is, we don't buy the dip, we buy the bounce. So we'll wait for the markets to perhaps bounce. A couple of points indicating that perhaps the market could settle somewhere close to these levels is the first, that there's a 20-day moving average support which might kick in. Also, we are starting to see some sort of put base being created around the the 19,600, 19,700 kind of level. So if that does sort of hold up, then we might hold on to these levels. If not, then 19,500 is the next level that we're looking at.
All right, 19,500. Yes,
19,500 will be the key support, as Kush is saying. Kush, now in light of the recent correction, now market was in a need of some phase of consolidation after Nifty having run up about 1,000 points in a matter of a week. Now how do you see the market's position currently? Is it still a buy on dips market, or has the sentiment turned bearish?
Well, it looks actually, it depends on the kind of horizon that you're looking at. As I said, if you're looking at a few months horizon from here on, then this opportunity might turn out to be, a buy on dips kind of a setup. If you're looking at the near term, then there's no two ways about it that, we are in a bit of a, downtrend here. Although we may be closer to the support zones now, so a fresh shorting from these levels, may not look as attractive. So yeah, if you have anywhere from 3 to 6 month kind of a perspective, this dip might turn out to be a buying opportunity. That's how we're looking at it. Even on the bank Nifty, see, the signs were there. If you look at the 46,000 kind of levels, Bank Nifty attempted that somewhere in the mid of July and wasn't able to sustainably cross those levels. Similar was the case, just until about a week ago, where we tested that 46,000 level. We went above that, but we weren't able to sustain. So the lack of strength was very clearly evident, in Bank Nifty as well. So the fall is not surprising. The pace of it is perhaps a little surprising. But if you look at the overall trajectory, the result season will start, kicking in from, let's say, about a couple of weeks from now. So that could perhaps act as a fresh trigger. So we are looking at this as a buy on dips if your perspective is a few months down the line.
Kush, as you said that there has been some weakness in the market, at least at higher levels, and you also touched on Bank Nifty. Talking about Bank Nifty, just last week Bank Nifty was within a touching distance of its record high levels, but just in a matter of 3 days the index has corrected about 3.5%. Now what's the big overhang for the banking pack?
HDFC Bank. I mean, there we've got a very clear answer. In fact, if you look at the entire move, not just Bank Nifty from, let's say, about 43,500 to 46,000. If you look at Nifty also, when it started moving from that 19,500 to about 20,000 odd levels, Reliance didn't participate and HDFC Bank didn't participate, and these are the two big boys. So if your marquee names are not performing, if the biggest of the heavyweights are not performing, then there is a very clear overhang that is sort of likely to come in. Now PSU banks was the theme, and that is what pushed the Bank Nifty a little higher. But if you see, even SBI hasn't really contributed as much. So since these big names aren't really contributing in a big way, you will see this kind of pressure at higher levels. So if Bank Nifty has to indeed cross 46,000 and sustain above that, you would need the likes of SBI and HDFC Bank to perform. See, Kotak has an overhang of its own going. ICICI is on a strong footing, but really hasn't contributed as much. So some of these big names starting to kick in will actually do well for the bank nifty. And we do see some kind of support zones being created at those levels. My only concern is HDFC Bank still doesn't seem to have bottomed out. If you look at the charts, the stock is despite all kind of news and clarity around it, it's still actually slipping lower. So I would wait for HDFC Bank to settle, and then perhaps take a cue from there and go long on Bank Nifty.
Actually, my next question to you was about HDFC banks. As we know, it has been under selling pressure. In fact, I was reading a report which suggested that HDFC bank alone has wiped out about 1 lakh crore of investors' wealth in just a matter of couple of days. Now, as we know, there are some headwinds as far as post the merger with the parent company HDFC is concerned, and several brokerages, especially foreign brokerages, have also considerably cut down the target price on the stock. So how does one navigate the stock at current point in time, and at what levels HDFC Bank once again becomes an attractive bet?
And just to add to that, I remember speaking to another expert on the show, Gaurang, who was very upbeat on the HDFC stock, specifically mentioned strong fundamentals of the bank, and therefore the pricing will sustain, perhaps will come back to its pricing in a week or two from now. What's your long-term view on HDFC stock, as well as bank's capability to perhaps sustain a good price point for its stock?
Well, from a fundamental standpoint, I don't think there's an issue. However, the hangover and the clarity, at least a couple of quarters of how the merger plays out, is something that the street will actually wait and watch. But if I look at the price action, I'm going as far back as November, even October of last year, and the prices were fairly similar, or maybe just about there. So the stock's actually not done anything, despite all kind of clarifications and all kind of statements that we've been hearing. So see, this has not been a trader favorite counter anyway, right? I mean, HDFC Bank, Reliance, both these big names aren't really a trader counter. So you'd want to approach them from an investment standpoint. So if that is your time horizon, if you're looking at anywhere from 12 to 24 months kind of a time horizon, these dips will turn out to be a buying opportunity, even though you're seeing the stock perform in a range. This is now closer to the lower end of the range. So 1500 is a very strong support zone for the stock. So I would look at accumulating at this stock even at this level. Even if it slips to let's say about 1500 odd levels, I'll be fairly comfortable, because my horizon is anywhere from 12 to 24 months. Near term, the pressure is very clear. It might see a technical rebound because it's approaching oversold territories and also approaching its support zone of 1500 kind of levels. So from a trading perspective, yes, but I don't think too many traders have a position in HDFC Bank. It's more of an investor story, more of a positional buy. So even though the stock's not done well, I am not too worried in terms of the entire structural play. It's not done too much in the past year or so, but we know the reasons why. So give it a quarter or two. I think that's when the clarity should start emerging, and the translation into the price action should also start kicking in.
Now, Kush, among us, there has been a lot of negative cues in the markets, but there was one bit of positive news that came in this morning, that JP Morgan has decided to include Indian bonds in its emerging market index. Now, Indian bonds will make up a maximum of 10% of the index, and HSBC estimates that this inclusion will lead to a potential flows of about 30 billion. Now, of course, it is a big win for Indian bonds, but what sort of an impact do you see on other asset classes, particularly equities?
Well, to begin with, what we are seeing is an immediate reaction. The Bank Nifty was a rank outperformer for the last couple of days, right? But today, if you see, it's holding up in the green territory, even if, barely so, it's still holding up in the green territory, and the Nifty rather slipped into the red territory. So we're seeing a bit of an impact already with the financials sort of, trying to, hold some ground. What I have been hearing from, other discussions is that this is perhaps the first of many such inclusions, perhaps the biggest. But if we get included in more such indices, then the inflow number could be higher. Of course, it will be staggered, but that augurs well for the Indian bond space as well. You're seeing some traction in the likes of Bajaj Finance. You're seeing the traction in the likes of Chola Mandalam and Shriram Finance. Incidentally, from the non-banking space, these are some of our top picks. So definitely a positive on some of these names. My only concern is once this news sort of pans out or sort of plays out, the hangover sort of is wiped out, will these stocks sustain and move higher? It will still depend largely on what kind of inflows are coming to the equity markets directly, which have not been so great. Of late, we've been seeing FII selling pressure. So I'll wait and watch. But these are certainly some of the names that could at least get some sort of support from this news. And Bajaj Finance, Chola Mandalam, Shriram Finance, as I said, these are some of the names that I have on my radar. As in when the tide turns, these might perhaps be the first ones to rise and rise higher, harder and faster.
Now, Kush, Glenmark Pharma and Glenmark Life Sciences was in the news. Now, Glenmark Pharma will sell about a 75% stake in Glenmark Life Sciences to Nirma Group. Now, Nirma Group is not a traditional pharma player. So, how are you looking at this buyout?
Yeah, well, I don't really track this from a fundamental perspective, but then what we understand is Nirma sort of delisted itself just to perhaps dabble into these ventures where they wanted the kind of autonomy where they could perhaps share their expertise, get into this space where the shareholder concern is not a big deal. So while from that perspective the view remains this, from a share from the price action perspective on Glenmark Life Sciences and Glenmark Pharma, so we are seeing a bit of a consolidation play out in the space, aren't we? Glenmark's already sort of done its thing. Cipla, we hear at least if not the entire thing, some part of it is on the block. So this consolidation will keep the entire pharma space very interested. Plus, I think there's also the word of PLI scheme coming into the pharma scheme, pharma sector as well. So some of these news will keep, stock-specific action intact. Although, just by the look of it, Glenmark Life Sciences and Glenmark Pharma both haven't really done too well, despite the news. So I would actually avoid these stocks if I'm looking to, buy any of them.
Kush, Vedanta is also in the news now. Vedanta is also looking to take on additional debt of about 2,500 crore rupees. And this comes at a time when the company is already under the scanner for, massive amounts of debt on its books. So, is repayment for the company going to be a problem? And if so, what sort of an impact do you see on the stock?
Nothing too positive at all, and I think that's very clearly visible because the stock made its this year's highs right at the beginning, in the starting of the year itself. Jan was when the stock made its high, and it's already been in a severe downtrend ever since. So I don't see this as a very encouraging move from the company's perspective. And when we translate into the stock price action, again, not encouraging at all. I'm looking at this stock from daily, weekly, monthly, all sorts of time frames, and it's actually slipped below a lot of its key averages. So this is actually a shorting opportunity. The only minor concern being that the stock's approaching a very psychologically important level of 200. Now technically it does have some relevance in the sense that it had support zones about a year ago, somewhere around these levels. But psychologically also we understand that these numbers sort of tend to play out. If it holds to about 200 odd levels, then fine. If not, then we could perhaps see it slipping lower to 170 also. So very clear avoid, just that the shorting opportunities perhaps missed because the stock made its high in the beginning of the year around 330 odd levels and has been in a severe downturn from there. So a very clear avoid on this one.
Now, Wipro was another stock, Kush, that was in the news today. Now, Wipro's Chief Financial Officer, Jatin Dalal, has decided to step down, and Aparna Iyer, who is Wipro's full stride global business CFO, will take over from September 22, which is today. Now, the stock has been under pressure in the last 5 days. It is down about 4%. It was also trading with moderate losses this morning. How is the stock looking on the price chart?
When it comes to the big four names of the Indian IT industry, which is TCS, Wipro, Infosys, HCL Tech, in the pecking order, Wipro has always been number 4 on our list at least. It's not really sort of performed even when the entire IT pack was doing phenomenally well. Been a very a mellow kind of a stock, been in a range for a while now, so it's never really been on our radar. I don't think the news, although it's just, organizational, it's more operational, but it's not done, any favors to the stock. So for us, if we really were to pick something from the IT space, it would be HCL Tech and, TCS. And if I have to then, skip the gun and, move on a little lower to the, mid cap names, then Persistent and Bsoft are the other two stocks. So it doesn't really fall on our radar, Wipro. And I think it's very evident from the stock price action why, right? Not done, too much in terms of the recent moves as well. So I would avoid Wipro, for now, and just share the top picks that we have from the large cap and the mid cap space in the IT industry.
All right, Kush, always a pleasure speaking with you. Thank you so much for taking time out and for joining us this morning.
Likewise, thank you so much.
And thank you to you too, Suyash, for all your inputs this morning. But shifting focus now, and I think one of the stories we continue to track by the way of Adani and their joint venture to redevelop Dharavi. My colleague will be Karthik Malhotra walking into the studio. Will be walking in, perhaps is walking in right now.
Morning.
Good morning, Karthik. It looks like there is now a JV with Mumbai slum redevelopment to facelift Dharavi. What's happening here as far as the JV details is concerned?
Right, Shweta. So, this comes, of course, as we had reported even on our News 9 Plus documentary last year, that Adani Group had won the contract to redevelop Asia's largest slum, Dharavi, which houses about 1 million people last year, for a bidding value of $610 million. Now, the next logical step for this was to form a joint venture with the state government, and that joint venture is now likely to happen in an 80-20 ratio, with Adani Group holding 80% volume in that JV and the state government holding the balance 20%. Now, what this would further entail is that the state government would appoint a chairman and Adani Group would appoint a CEO to oversee this redevelopment. It's actually beyond a facelift. It is pretty much redeveloping that entire mass of land and the housing and the industries settled in Dharavi, and really give it a new lease of life, so to speak. So this again, it comes at a time when Adani Group has been mired in controversy after controversy. We've seen what happened with the Hindenburg report. The SEBI report yet to be presented in Supreme Court, so we don't know where that is going to go. Then the OCCRP, which also re-emphasized on Adani Group's, allegations against Adani Group for some sort of profiteering on account of short selling. And now Dubai-based SecLink, a company which had also bid for redevelopment of the Dharavi slums, has been taking Adani Group and the Maharashtra state government to court, suggesting and alleging rather that there has been wrongdoing in order to give preference to Adani to back the contract of the Dharavi redevelopment. So all of this coming at a time
when... What
when,
rules were flouted?
So apparently the bid presented by SecLink was cancelled. There was a time extension given and some rules were altered to give some sort of a favorable position to Adani Group versus Dubai-based SecLink. So those are allegations, and this has been reported by Reuters. We don't have an original input on this, but from what it seems, that now with this JV actually crystallizing, there is actually going to be a master plan presented. There is going to be some sort of a formal hierarchical, structure set for the redevelopment process, with the appointment of a chairman by the state, with the appointment of a CEO from Adani Group, and thereafter the master plan and the further redevelopment of the Dharavi slum should commence.
All right, and the timeline for redevelopment stays?
We don't know actually. It all depends on the master plan, because once the master plan is presented, it'll go through multiple rounds of approval. It is going to require the state and the Adani Group to work together, and there are going to be shutdowns, there are going to be closures, there are going to be trucks coming in for redevelopment, some breaking down of structures, etc. So I think a lot rests on the master plan, and once that master plan gets a go ahead from the state government, then perhaps fresh timelines, depending on what the master plan entails, should roll out.
Okay, but at the heart of all of this, this is a human story. This is a story about people living in Dharavi. I'm given to understand they're also concerned about these fresh reports and the existing allegations on Adani.
Again, the Reuters report published last month actually suggests that the residents of Dharavi, the million-odd people who reside in the slums, are concerned post the allegations by Hindenburg Research against Adani. But I mean, to be fair, we know Adani has built large ports, large airports, roads, highways, etc. So redevelopment of a certain mass of land technically should not be a problem for Adani.
Absolutely.
And it doesn't, no reports right now suggest that the group is likely to go insolvent anytime in the near future. Now, it has been trying to repay its debt on existing loans that it had taken and sort of shore up its deleverage itself and become more attractive to investors by way of deleveraging. So there is nothing that suggests that Adani Group does not have the technical capability or the financial muscle to pull it off, right? It will be able to pull it off. It's just that I think all these legalities have to be out of the way.
Absolutely.
All allegations need to be out of the way, and a robust master plan that should work both in the favor of the state of Maharashtra, the Mumbai authority, as well as the people residing in the slums.
All right. So the Adani JV for Dharavi is likely to be on course. It does appear that there is no fresh hurdle apart from except the allegations that have been leveled against Adani. People are scared, they are worried, but redevelopment plans for Dharavi will go on as planned. But moving on now to a story that's come in yesterday by the way of fresh definition for who is a willful defaulter and how soon will they be tagged as a willful defaulter from Reserve Bank of India.
That's right, Shweta. So, willful defaulters is something that I think came into existence when we heard of Vijay Mallya not paying back the loans that he had taken from multiple banks, and then the Nirav Modi saga that carried on, and then we've seen so many other willful defaulters as popularly referred to. But RBI
willful,
is now,
I mean, as the name suggests, willful is people who have the money,
absolutely,
are not ready to pay up.
So in the definition that the RBI is proposing, the change in norms which RBI is proposing, who is a willful defaulter? Willful defaulter is somebody who has the money, has the ability to pay, but decides to not pay or divert funds. So that becomes definition number one, or point number one in the definition of willful defaulters. Number two, very interestingly, is the borrower should have a liability of 25 lakh rupees or above to be paid to the banks. So if your liability to the bank is or from whichever lender you've borrowed money is under 25 lakh rupees, you cannot be labeled as willful defaulter. So somebody runs away with a home loan of 20 lakh rupees will not be called a willful defaulter. The threshold begins at 25 lakh rupees. So 25 lakh rupees spending to a lender classifies you as willful defaulter. Now what happens after you are classified as a willful defaulter? Number one, you need to be labeled as willful defaulter if you have not serviced your loan for a period of 6 months, and after you have been classified as a non-performing entity, a non-performing asset on accounts of the lender, within 6 months the tag of willful defaulter needs to be added. Now what happens if you are able to repay that loan, even if as a willful defaulter you have repaid the bank the loan that you had borrowed for a period of 1 year, the bank should not lend any more debt to you. So this becomes another new addition, that you may be classified as willful defaulter, you may get out of that willful defaulter tag by paying your debt, but for a period of 1 year the bank will not issue any fresh loan to you. And next in line comes the question of restructuring of loans. A lot of times there are negotiations that both parties engage in. Now RBI is telling banks and NBFCs for that matter very categorically that once you've classified somebody as a willful defaulter, the first two criteria are met, no further renegotiating the loan terms, no further restructuring of the loan. Now one more addition to this, equally important, I think, is the fact that once you have repaid your loan for a period of a year, you cannot seek any further loan. But it's not just the entity alone, it is also the management of that entity. So if it is a company which has defaulted, then the promoter of the company, the management which is in charge of running daily operations at the company, as well as any other subsidiaries of the company or any other joint ventures that the company has, which has not directly engaged in seeking that loan that it has defaulted on. All of these separate entities will also be labeled as willful defaulters.
Okay.
So it pretty much suggests that the promoter, the CEO,
Everybody
CFO, as well as any other subsidiary that you have, all of it gets labeled as associates of the willful defaulter and hence deemed as willful defaulters themselves.
Okay.
So I think this, of
so
course,
the
is the
umbrella
biggest.
of willful
Yeah,
default
so you can't
has
say that, hey,
widened.
I'm the CEO of the company, my company has defaulted, let my company not get any further loan, but I can go to a bank and I can borrow money for my personal expenses.
Right.
You are also directly labeled as a willful defaulter.
Okay.
And you may say that this company has defaulted, but I have a subsidiary, and that subsidiary can go to the bank and take some debt. RBI says nothing doing. If you have a subsidiary, that subsidiary also gets classified as willful defaulter.
Okay, very interesting. A very wider definition, and all of this comes on the back of the fact that for the last many years, in fact, prior to this government, for last decade or so, willful default has become a talk of the town. A lot of people who have the ability to pay back do not pay back. The couple of issues, you know, perhaps as journalists, we've been talking about, we've been trying to divulge into for past many years. Specifically in case of inflated mortgages, where a lot of people put, you know, a lot of land document, house documents, especially when it happened with not just Nirav Modi but Vijay Mallya as well, where lots of bungalows were put in for mortgage, but they did not actually match up to the cost once, you know, the company became insolvent and the mortgage had to be then utilized. You realize suddenly that the banks and the people were in cahoots with each other and the mortgage documents were inflated. All of that perhaps will also be taken into account, because that continues to be a major problem.
Yeah,
a person's ability to pay back is also depends largely on what sort of you know, property they have, what sort of assets they have, movable, immovable, and specifically with immovable, there is a nexus that, you know, we see every now and then.
Sure. So, you know, I believe, Shweta, you need checks and balances at every stage. Now, you cannot really expect a bank to have enough and more auditors across multiple facets of movable or immovable property to assess a fair value. Now, what happens in case I put my flat up as a mortgage today? If I want to seek a business loan and start of my own, if I put my house, you know, up as mortgage today, what is the fair value of that flat today? And what is the value likely to be 5 years from now or 10 years from now when my loan term ends? Is there a formal check and balance in place? So what we really need is an ecosystem of independent evaluators. We need an ecosystem of independent assessors who are able to put a best case, worst case, average case scenario for a bank for that property to be really accepted, or that asset to be accepted as mortgage, which should see through the quantum of loan that a borrower has taken. So I'm not sure if it would be fair to say that entities and financial institutions work in cahoots. I think there's just so much paperwork, non-digitized for a lot of immovable property, and property, you know, based in some other city. You're taking a loan from a bank, you know, in another city. Who assesses the value of the property,
bank is supposed to send a representative, which is what has come out, in fact, been unearthed in Vijay Mallya's case as well, where bank sends a representative every time you try and mortgage a property to go and assess the cost, and a lot of things are function of what the property costs.
Eventually, you know, property, real estate, you will still need a real estate expert. You'll still need a
which
body,
doesn't happen.
Which, you know, which may be happening. But then, how does even that real estate organization and even the bigger ones give you a very concrete value of that property 20 years from now, 10 years from now? Is it going to appreciate? Logic tells you property will appreciate. Is there going to be a slump at a time when you really want to, you know, dispose that property off and seek the money back? You don't know. So, you know, I think it's pretty much like what happened in the US, the subprime crisis that happened in the US. Banks were lending money and people were buying property because interest rates were so low. And those properties, of course, became the mortgage for the bank, that if you are unable to pay your loan, the bank sells that property. But what happens? There's a slump in property. Banks are now inundated with acres and acres
of
worth
land and
of
property.
land and property, which doesn't
Very
find takers.
low value.
So property is always a demand-supply game in
Absolutely.
any case.
Absolutely. But I think all in all, a good expansion of what is willful default and how willful defaulters will be tackled in days and months and weeks to come from here on, and tightening of news there on people who can pay back, who have an ability to pay back but do not end up paying back to the banks. Definition of willful default has now been widened. But moving on, former UK Prime Minister David Cameron and MD CEO of TV9 Network Barun Das sat. They discussed India's geopolitics, the emerging world order, all those details and that exclusive conversation on Duologue today, in fact 10 p.m. today.
Two Indophiles confess their affair with India.
Is it fair to call you an Indophile?
Very much so.
You wrote about China.
A local problem is a global problem.
It's called global inflation.
Who is responsible? And it is Putin's.
Duologue with Barun Das, featuring David Cameron. World premiere on Connected TV. Tonight at 10. Only on Newsline Live, India's first and only digital exclusive English news stream for Connected TV. Supported by Alliance Broadband.
All right, that interview, an exclusive at that, will be aired at 10 p.m. on Connected TVs at your homes tonight. Moving on to a story that is coming by the way of savings. Are Indians' savings enough? If not, is it because they are not earning enough? All those questions, of course, in realm of speculation. But the story that is breaking is that household savings are at a 5-decade low, a decadal low. What's happening?
So, Shweta, yes, you're right. If you look at the number as a percentage of the GDP, household savings are at its lowest ebb in 50 years at about 5.1% of the GDP. Compare this to the same percentage of GDP last year, it was at 7.8%. So there has definitely been a decline in household savings from 7.8% to 5.1%. Now at the same time, the household liabilities, the loans that households have taken, have incidentally gone up from 3.8%, a good 2 percentage points up to 5.8%. So what these two data points suggest to you is that households are saving less and households are taking more loans. That is what these two sets of numbers tell you. Now, the big question is it bad news? Look at data, not just these two data sets, look at data in its entirety. What is happening? Now, of course, the Indian economy is also growing, $3.75 trillion. As a direct volume of that, even a lowered, savings from 7.8% to 5.1%, as overall the size of the economy may reach almost a same volume figure between last year and this year. But how does it matter? The fundamental question is, if you have lesser amount of money in your bank, is it a cause of concern?
Okay.
One school of thought says, yes, absolutely, cause of concern. You don't have enough for the rainy day. There is inflation. Inflation is eating into your savings. You're spending more from the money you had saved to deal with your day-to-day consumption, to deal with the soaring vegetable prices, tomato prices, onion prices, veg thali, etc. that we have spoken enough and more about. But then there's another school of thought. The other school of thought says that you're saving less because you're investing more. You're saving less because you want to reduce your EMI by putting a larger chunk of your savings as down payment.
Okay.
Whether
Hang
it is
on.
buying
Is
a house.
investment not saving?
Investment is not saving.
Okay.
In fact, the National Stock Exchange, SEBI, RBI, everybody has been, for the last almost a decade or so, at least if memory serves me right, has been talking about this concept of financialization of savings. When you invest money, it is financializing your savings. When you save money, it is just money lying dead in your bank account and drawing you a much lower rate of interest as compared to an investment that you make with that money. So look at data of SIP inflows. Month on month on month, you're seeing retail participation in financial markets going up. So people are putting lesser money in their banks and perhaps more money in stock markets. Through SIPs, through mutual funds, direct retail trading, as the case may be. Look at car sales. Car sales for the first half of FY23 had reached the figure of 1 million cars. 10 lakh cars were sold in India between 1st Jan and 30th June. Look at housing data that comes in. People are borrowing more money to buy more physical assets. That's something Finance Minister Nirmala Sitharaman has also said, but
and so did
her
the
statement,
SBI report yesterday.
absolutely, her statement came, I think, much after you and I had that informal discussion, discussing what's the big deal about financial, savings, household savings going down.
Okay.
Now, every country also works on debt. You have a debt to GDP ratio in excess of 80% for any average emerging economy. So, growth by default happens on debt. You leverage yourself to be able to buy assets which you don't have the financial muscle to procure by putting an upfront down payment. Okay. So, savings reducing on account of inflation. Inflation alone is a cause of worry. Had we seen this decline in savings without that inverse correlation with housing doing better, with car sales doing better, with FMCG consumption, not doing as well, then there was a cause of concern. But when you juxtapose this data of reduced financial savings, increased borrowings, keeping these other data points in mind, I think it is a signal of growth. It is a signal that Indians have finally understood that keeping money in the bank does not beat inflation. A saving bank account gives you nothing more than, at best, even in an increased, high rate environment that we are living in, 6%, 6.5% rate of interest. All of that is subject to a 30% tax if you're in that tax bracket. So what you actually get in hand by keeping money in your bank account, would be nothing more than about 4% or so. So 4% versus inflation, definitely in excess of 6%, 7%. So you actually end up losing money by keeping it in the bank, as opposed to market returns over 10 years. Stock markets have given you about 12%, 13% return. Okay. So financialization of savings is a story to celebrate, and reduced household savings in the context of all this data is nothing to worry about.
All right. So my colleague there, not worried about household savings at 50 years low, especially if you take into account other data points that have come in by the way of not just, if it were just inflation, that would be a sign of worry, but if it were to be, as SBI points out, people investing in immovable assets like property, putting it in mutual funds, that is something to celebrate. What is not to be celebrated is perhaps people buying more cars, people buying more consumer items.
Not to be celebrated? I think it is definitely a cause of celebration. Okay. You are financially mobile. You are
but it's very I think it's consumerism.
How else will industry fire? Okay. If people don't buy cars, how will the auto sector is pretty much the reflection of the health of an economy. Okay. If car sales are doing well, you know that your urban economy is firing well. If scooter sales are doing well, or two-wheeler sales are doing well, you know that your rural economy is doing well.
But household economics will tell you that one car is enough, don't end up buying 3 to 4, which is also a concern. A lot of people
I'm not sure that's practical. Okay. Do we have the public infrastructure right now? I mean, it's going to take me, if I take the metro from the sector where I live to office every day, if I take the metro, it is going to take me about an hour and 10 minutes to get here. If I take a cab, I'm still spending about 500 rupees up and down every day. Am I not better off creating an asset which gives me the comfort, the convenience, and at the same time help the auto sector grow, which also pays GST, which also employs more people, and hence the multiplier by account of me buying a car versus taking the metro, I think is much, much higher.
Okay, well, it's a long debate, but nothing to worry about as far as household savings is concerned. In fact, another interesting story and something to celebrate perhaps is how big Apple is banking on India. From a 9% of the total exports back in the second quarter of last financial year to nearly 49% of the total exports this June quarter is a story in itself. Apple is firing up all its engines here in India. Perhaps India could be the next home after China. Or in fact, even, I don't know, beat China at that.
No, sure. I think, the ground is set for that India-China battle to actually now rage on, and especially when it comes to manufacturing, where China had been the front runner, India had been a laggard. But what we've seen by way of of Apple upping its manufacturing here in India, the data is fascinating. Last year, and it's not just Apple eating into Samsung's share. Samsung till last year was the largest. In fact, even till early Q1 of this year,
still the largest.
Samsung was the largest manufacturer of smartphones in India, and we are just talking about what is being manufactured in India,
In India.
by way of these two companies. So Samsung was doing the bulk of smartphone production in India, and Apple being a distant second last year. It inched up from that 9% you mentioned to about 40% of market share in Q1 of this year. And Samsung's dominance had reduced to about 45%. And look at the data for Q2 of 2023. You have Samsung being pipped squarely by Apple. Apple now producing as much as 49% of India's smartphones, and Samsung now relegated to just about 40% or so. So I think what this means is that, of course, there is Apple's faith in India versus that on China. So, and Apple is definitely upping its production here in India. At the same time, it's also a telling sign of this tectonic shift which perhaps is happening from Android to iOS. And I think that data again is fascinating. You come at a point where Android was the largest market of smartphones across the world, especially in India. And now with more and more manufacturing of Apple products happening, it also tells a sign of perhaps that Android dominance across the world ending and Apple really eating up into that share.
All right, Apple definitely eating up into that share. Overall, although the exports have declined marginally from 13 million in the first quarter to about 12 million in the June quarter. Sequentially, there's been a very slight blip,
but
though,
look at
nothing
it
to worry about.
Why Q2 last year,
that's a big
8
jump.
million to Q2
12.
this year, 12 million. It's a straight up 50% growth. 50% more smartphones are being manufactured in India. So 8 million to 12 million is a good number, and a bulk of that, a good 50% of that, half of that, is Apple, is again, something to rejoice.
I'm just very fascinated by the growth from 8% to 49, 50%. I mean, I think that is something that wonders me as to how quickly it made India its home and how quickly it expanded in a period of 12
because
months.
you are completely dependent on contract manufacturers.
That is correct.
You have Foxconn, you have Pegatron, you have Wistron, and you have these three companies availing the PLI facility that India has offered them, and really ramping up production. So I think it's that complete faith in the players who are contract manufacturing for Apple and really pushing them to go ahead and make more.
Okay, and another company that is hoping to get more incentives and banking big on India is Tesla. Tesla is hoping that it will start its battery manufacturing in India very soon, perhaps.
Yeah,
that is what the reports are suggesting.
Correct. So it's not really going to be battery manufacturing as I read it, Shweta. It's going to be battery storage and energy storage. So what Tesla is proposing through something called Powerwall is that it comes into India and it is going to set up plants and large-scale photovoltaic cell sort of plants which are capturing the solar energy. This is in the space of renewable. You capture the solar energy, you store it, and then you transmit that to the grids. So I think Tesla for sure is trying to make inroads into India, if not immediately through selling Tesla cars, and that of course is a separate story altogether, then at least get some sort of an entry into India and set up some project in India. We've seen Tesla cars, we've seen Starlink, reports of Starlink wanting to come to India. We've seen enough and more reports of that of Elon Musk's team coming and having discussions with the Ministry of Power, with the Ministry of Heavy Industries, with Industry Minister Piyush Goyal as well, and really trying to enter India. And now this Powerwall becomes this new technology where you store solar energy and transmit it back into the grids and power up households and industries.
So it's going to be a battery storage factory.
That's right.
All right. So those, of course, are fresh plans that Tesla has for India. Remember, it's currently exporting almost 1 billion worth components from India, likely to double that up to 2 billion worth as of next year. That is what the government is saying, of course, at this point. We'll have to wait and watch. But Tesla is also, betting big on India after Apple. We don't know how plans will come into fruition, if at all or not. But those are interesting, important stories that we continue to track here on Newsline. Thank you very much for watching.
BrahMos, stealthy, lethal, precise. It flies at 3 times the speed of sound and cuts through a warship like a hot knife through butter. China's navy has threatened its neighbors, and they are turning to the BrahMos for protection. The Warship Killer. This and more streaming on world's first news OTT, News 9 Plus. Download now.
मैं इमरान अहमद खान नियाजी सबके दिल से हल्फ उठाता हूँ.
When Imran Khan came initially into politics, he thought his personal popularity would be sufficient for him. It didn't happen.
The retired military generals are openly saying that Imran Khan is a better choice.